Well, 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 after yesterday's massive great day in the market, $68,000 in the public account, I thought let's go ahead and bounce back here today with two very negative videos, okay? First one I want to react to is from a few hours ago. Auto and credit delinquencies are, quote, signs of cracks for the economy. I want to watch that one, give my opinions and perspectives. Obviously, that's a subject that is, being talked about quite a bit now at this point in time. We have definitely charge-offs starting to climb, credit delinquencies in general starting to climb, so I thought that's an important subject to speak about. Second subject I want to talk about is this video here today. Is bond market is screaming that recession is coming, says Nancy Davis. Want to hear what she has to say. Where are they recording this at? Santa Monica? Where is this at? This should be interesting. So can't wait to get into that one. Appreciate everybody joining me as always. Let's jump straight into this, folks. Oh, by the way, pin comment down there. Brand new workshop I just put together for you guys. It's a 5-day workshop. It's absolutely free to access that. It goes over all those subjects right there. That should help you out immensely. So make sure you check that out when this video is over here today. That is pin comment. Thanks for being here, folks.
Alex, you think that at least for some tech stocks, things could get better here, but aren't valuations stretched, especially in the AI hype? Why should we believe that tech is a good spot?
I think as the Fed pauses and yields start to roll over, that'll be a tailwind for tech stocks, but there's going to be winners and losers. Let's start with Apple, where no news was bad news for the stock today. Just coming out of their event, really just incremental news on new products. The iPhone 15 is just an incremental upgrade to the prior iPhones. Also, two other headwinds from COVID in China. They're dealing with COVID normalization of units and also China headwinds with 20% of their revenues from China. Expected negative revisions for their earnings and a premium valuation. So I think that's going to be a lot of headwinds for Apple and Oracle too.
Okay, first off, preaching to the choir in regards to Apple. Yeah, thank you very much. Obviously, me and my Apple puts are sitting pretty as of right now. We'll see where it goes over the next few months. But yeah, no disagreements there. And when it came to the event today, it was exactly what I was expecting. I was not, I knew nothing big was going to happen today. I knew they weren't going to show off anything game-changing. When it comes to these Apple events, everybody, if you research this at all, you already know. I knew what the iPhone 15 was going to be months ago, literally months ago.
Growing pains from their Cerner acquisition, issues in their cloud business. And this was a crowded value stock coming into earnings. So not surprised to see Oracle also down today. But then there's winners.
I'm doing a lot of research on Oracle right now, okay? And here's what I'll tell you about my initial Oracle research. Am I liking what I'm seeing so far, or am I not? Is this a potential stock I'm buying, or is it not? In regards to Oracle, there is a potential this could be a stock I buy at some point in time. I like a lot of what I see. The only thing, really the only thing I don't like what I see with Oracle, balance sheet. Bad balance sheet, man. Bad. And I'm like, there's no reason it should be like that, but they have huge debt loads. Done some massive share buybacks in the past, some acquisitions, and they have just piled up the debt. And it really shouldn't, it doesn't have to be that way. And they've been spending so much money on dividends and buybacks rather than just paying off the debt. So that's the one really negative thing. So I still got more work to do in regards to Oracle. I don't own any shares as of right now, but let's just call it rapidly looking into Oracle right now as fast as I possibly can.
The software space, like Palo Alto Networks, these are companies that could benefit from a slowing economy, low M&A risk for Palo Alto Networks, revenue growth based on the cloud. So these are all, so there's going to be a lot of winners and losers. We like software stocks, semiconductor stocks that are suppliers to AI, but there's also going to be losers like Oracle and maybe Apple going forward.
Okay, I hear you, but I got to say, people have been saying that these iPhone updates are evolutionary, not revolutionary, for at least the last $1 trillion in market cap. So I don't know. But okay, so let's talk macro a bit. When it comes to CPI, right? That number.
So let's be very clear. iPhone's latest numbers were not good. Like over this past year, iPhone revenues are actually down quite substantially. We're talking billions of dollars, not a small amount. Billions of dollars our iPhone revenue is down year over year. Obviously, 2020, 2021, a lot of stimulus money out there. A lot of people are buying the new iPhones, right? But certainly we started to see, even at the very end of last year, but certainly into this year, a huge pullback on iPhone. And we might see more pullback on iPhone, so keep that in mind.
Take on the downside or on the upside, depending on how you look at it, in that number to move markets one way or another?
Well, going into CPI, we think there's going to be three factors people are looking at. Headline, CPI, goods and services. So we think headline will be stronger than core because gas prices are up about 7% since July. Now, digging into core, goods services should show a decline because of lower car and truck prices, but services should still continue to accelerate. The wild card will be airfare prices, and we expect continued heat in shelter prices and also healthcare prices.
I can't wait to see what the Bears do. I cannot freaking wait until CPI numbers come out because I can't wait to hear what the Bears have to say. I really can't, because their whole thing, certainly for the past 6 to 9 months, was don't look at just CPI in general because, energy prices have come down so much, right? And so they've kind of looked at that as like, if that comes back, that CPI number will rise, right? Well, what's going to happen now when obviously the CPI numbers are pushed up because of gas prices? So I'm interested to hear kind of, if all of a sudden they want to look at core CPI, they just want to look at CPI in general, like that should be interesting.
Prices. If all of that is basically the status quo, I think markets will digest it fine. Now, if we see a hotter CPI number than that, especially within the core, then that Fed rate hike that has been priced out for September may be back on the table. We still expect the Fed to perhaps raise rates in November, though, before they take an elongated pause. I think one more thing the markets are worried about is, will we get rate cuts in 2024? We don't think you're going to see those in the first half of 2024.
I would love for there to be fear that breeds into the market about the Fed raising another quarter point. I would love that, okay? And here's why. Let's be honest. If the Fed raises a quarter point, let's even say they cut a quarter point, does that make any substantial difference? At this point in time, when you're talking about Fed funds rate over 5%, no, it makes no difference. The Fed needs to go up at least 1%, 1 percentage point, so 100 basis point, or down at least 1 percentage point or 100 basis point to really make any difference, in my opinion, now at this stage of the game. A quarter point move, it can move sentiment around, which I'm perfectly fine if sentiment gets negative here in the market, right? That'd be a beautiful thing, but that's not changing the game for either side, just to be quite frank in regards to that.
Sarah, have yields peaked, or is it still too soon to tell?
I think yields are plateauing. As we get to that final potential rate hike in November, yields will basically peak. And that's why we do like tech stocks from here. Not only yields peaking and the 10-year rolling over, but also inflation continuing to moderate. And the AI tailwinds, while they will take a long time to play out, they are real. So companies like NVIDIA, also Broadcom, the ones that can win sort of in any environment in the AI space, should continue to benefit.
All right. So disinflation. Is this a good thing for markets, or are there unintended consequences?
I mean, it can depend on the day. It really depends on the economy. And that's, to me,
it's interesting in regards to NVIDIA stock. All of a sudden, there's a lot of pushback on NVIDIA stock. People saying they're faking numbers and this and that. I don't know if you guys have seen all the stuff on Twitter and whatnot, and all this and that. I mean, the thing is, people were saying that last quarter as well. People were like, oh, it's fake orders, this isn't going on. And I don't know, man. We'll see. But, I've never heard anybody else in regards to any other big tech company ever have pushback when it came to their numbers or people, accusing them of being fake. At some point in time, I just think about how many people have shorted NVIDIA thinking the stock would go down and lost their butts this year and are looking for something to blame it on, right? No different than in AMC situation, GameStop, people are looking to blame it on the hedge funds and whatever. And now people are, that have lost their butts trying to go against NVIDIA this entire year and now trying to blame it on their faking numbers. Interesting. Jensen's willing to go to jail for, you go to jail for that. I don't know if people realize that. Enough for a short amount of time, for a long time. You fake numbers as a CEO of a public company and the CFO, you're going bye-bye. There's no defense against that. So you think Jensen's willing to do that? Come on, man. But like I said, people will make up whatever they want to in their heads to justify the fact that they've just got it wrong betting against NVIDIA this entire year.
There's a tug of war right now between economic growth and inflation. Investors are happy with inflation moderating as long as the economy continues to hold up. What's been holding up the economy is two factors, the consumer and employment markets. Employment markets still look strong to us. We like the consumer. We heard good news out of the conference today, but we are concerned about credit with the consumer. Auto delinquencies, credit card delinquencies are up significantly for the consumer. That is starting to show signs of cracks for the economy.
So that's a good point, and I think it's something to definitely keep an eye on over this next 12 months. Absolutely. But one thing I will say in regards to this that I think is very important that everybody understands this is keep in mind, if you're talking about auto delinquencies, credit delinquencies, any of that, these numbers are still very low compared to past times or even to an average normal time period, okay? Very low. They might be up a little bit from, where they were last year, which was pretty much like all-time lows in 2021 and 2022, but these numbers are not high on a relative standard based upon any sort of economic deterioration in any substantial way. But it is something to keep in mind. It is something that could get worse, and so that's why we need to be mindful of it. We need to keep it in mind, but it hasn't certainly reached a level yet that you need to freak out and like it's the end of the world, okay? Alrighty, let's get into this one. Bond market is screaming that recession is coming, says Nancy Davis.
Has been going in the right direction, which leads the Fed to, you would want to believe, think that they could be patient from here forward, don't you think?
I definitely think so. I think they've hiked too much already. They should have been using the balance sheet more. I feel like they keep hitting the same nail with the hammer over and over and over again. Like they have monetary policy. It's not one policy, it's policies. And that includes using quantitative tightening. And they've been really pansies about it. They really haven't gotten bold with reducing the balance sheet by having these caps in place. And then Silicon Valley Bank, they just created more liquidity and increased their balance sheet again in March to save the banking system. So I think they could really ease off the rate hikes, use more quantitative tightening with their balance sheet, and stop doing the same thing over and over and over again.
So just because you believe that they've done too much doesn't necessarily mean that they won't do more. Do you think, like Jeffrey does, that they're done?
I think we'll probably get one more hike. I'll take the over on that and say through the end of the year, I think we'll probably get one more. But I do think the market, if you look at Fed...
Is she rocking stockings? Because I'll be completely honest with you guys, I didn't even know stockings were still in. I thought stockings kind of went out like 20 years ago. That's what I assumed. I didn't even know stockings were still a thing. Literally. What?
Futures is expecting rate cuts next year. And I think that will be the real surprise for markets, right? Is if the Fed hikes and holds longer than what we're expecting, because pretty much all bond managers, whether you're a king, queen, or something else, everybody's coming out and saying, where are the cuts, right? Everybody is looking for these rate cuts. And it's kind of like deja vu a little bit, because if you think about, back in 2021, nobody was expecting the Fed to hike 5% interest rates in about a 12-month span. So I think it's very difficult. You don't want to be stuck with consensus thinking, and I think we'll have to see what the data shows, but it's also the Bureau of Labor Statistics, and revisions happen all the time.
So great point by her, and I think this is very important that everybody understands this, okay? You've got to understand the Federal Reserve has absolutely, positively no clue what they're going to do over the next year. And I mean 0% clue what they're going to do over the next year. They are clueless. They're looking at backwards-looking data, and they're letting the data judge where their policy goes, okay? This is why they got it so wrong on inflation when they thought it was transitory and it wasn't. This is why they got it so wrong in thinking they were only going to have to hike rates a little bit, and then they had to go all the way to 5% plus. This is why they'll probably get it wrong on the other side. You've got to understand they don't know what they're doing. They don't, okay? And that's just honest truth. It's not even opinion. That's just like factual evidence truth. They don't know what they're doing. They have no clue where their rates are going to be a year from now. Okay? So don't put too much emphasis on thinking the Fed's going to cut here and then, because they're talking about cutting here and then they're talking about not raising it. They don't know. They don't know, folks, okay? Completely clueless. And so, literally an average person at home throwing darts at a dartboard is the same equivalent of what the Fed will be doing a year from now. They don't know. They'll make the judgments when they get the backwards-looking data, and then they'll say, okay, I need to raise rates more. Okay, I don't need to raise rates more. You just got to understand that.
Bond market volatility is something that you obviously follow and invest on where you see that going. Would you be willing to say that the volatility in the bond market has been pretty modest almost throughout this whole stretch of rate hikes, except for a few periods where things got a little crazy?
Yeah.
How would you describe what you've witnessed in your expertise in your area of the market through a little more than a year of rate hikes?
Yeah, definitely vol is very muted. I think
I can't get over this. Are those stockings or is that just her skin? What in the world?
a lot of people focus on equity volatility, but the thing that kind of is lurking in all of your viewers, you have fixed income vol that you're short if you own things like mortgages. Any place you own a mortgage, if you think about it, a U.S. homeowner can prepay whenever they want. They own an option. If you own the mortgage, you're short options to them, and whenever you're short options, you're short vol. So the big surprise, vol has not gone higher, but if we do see an increase in fixed income volatility, that will mean price going down in mortgages. And so it's really important to understand things like the ag index. A third of the ag is mortgages. And then if you look at the Fed's balance sheet, it's still about $8 trillion. The Soma holdings have gone down about $1 trillion, but the balance sheet expanded with Silicon Valley Bank. A third of that is mortgages.
But Jeffrey likes mortgages, and he's liked.
Well, he's maybe the mortgage king. Maybe we can agree on that.
He's liked it because, and he made the point, you know, people are sitting in 3% fixed mortgages, or perhaps, you know, some maybe a little under, some maybe a little over. Who's moving? Who's going for the 7.5% mortgage now? So there's been such a degree of stability in that area of the market. Has that surprised you?
Well, it's all about modeling prepayment risk, right? So it's about interpreting what homeowners are going to do, how they're going to respond, when they're going to prepay. And it's very rational for homeowners to prepay when interest rates go down, but when they go higher, people don't want to move. And that's created more of a wealth gap in property prices because it's so expensive to buy a home now. Yep. If you're not already in real estate, what is a regular person going to do? So I think that's also another problem, going back to the Fed using their balance sheet more. A third of their balance sheet is mortgages. They can help normalize things because markets are distorted in fixed income. The yield curve is more inverted now than it was in the late 80s. You think you buy a 1-month T-bill and get paid 5 1/4, or you could lend the U.S. Treasury money for 10 years and get 1% lower. Like, that doesn't make a ton of sense, right? Like, normally you take more risk, you get higher reward. In this case, you take more risk with duration, you actually get less return. So the markets are definitely screaming that the rates markets, the bond markets, with this inverted yield curve, that a recession is coming.
Yeah, I like that Nancy Davis. She had a lot of good points. She just needs to get outside more and get a little tan, man. I'm white, but I ain't that white. Holy smokers, man. That's no jokers. But she had a lot of great points there. I don't disagree with any of those at the end. I think I've talked about those points so many times on the channel that I don't really feel like talking about them again. So appreciate everybody taking the time to enjoy today's video. Thanks so much for being here. Thank you for being subscribed, folks. Make sure you get that free workshop for you guys. That is going to be pinned comment down there. Much love and have a great day.